Hi again, this is Vince Valenti from Workaway Offices, and welcome to Chapter 2, Getting Your Business Ready to Sell. So you've decided it's time to make some ownership changes to your business. Congratulations. This is not an easy decision or one that you should be taking lightly. However, you've come to the conclusion that you can now start to work on and put the various strategies in place to sell your business. Selling a business can take several months to several years to complete, from the planning phase to the final exit phase. If you're thinking of retirement over the next few years, now is the time to start planning your exit strategy. A well-planned exit strategy will help to ensure that your clients and your employees are transitioned to the right buyer and that you'll receive the maximum value for one of your most valuable assets, your business. Let's take an inventory of your objectives during these early stages. You'll have to ask yourself a number of thought-provoking questions in order to develop a succession plan or an exit strategy. Same thing. Let's start with some of the obvious questions that you'll want to answer and some actions that you'll want to take. And I'm going to talk about the questions first, and then we're going to do a deeper dive in a few moments. Number one, what is your succession timeline? Two, you'll want to develop a buyer profile, and you'll want to make sure that the buyer profile will help you to find the right buyer, once again, to ensure that your clients will be looked after not only in the same manner, but also better. This is important, especially when you begin introducing your clients to the new buyer. Will you select one prospective buyer, or will you try to maximize your valuation by approaching multiple buyer prospects? How will potential buyers view your business? And it's time to get yourself organized. At this particular point, too, you'll want to review and organize your financial statements. Every prospective buyer will want to see at least the last 2 to 3 years of your financials. Another question, what's your track record when it comes to paying your bills and remitting taxes? If it's not good, you'd better clean this up. The other thing that I strongly recommend is developing a business overview document for prospective buyers. Again, I'm going to dig into this a little bit deeper in a moment. Review your business practices with the objective of what's going to be kept and what's going to be dropped. And then also communicate your plans to your employees, but be careful, we'll get into this in a moment, and to important stakeholders. What kind of financial arrangements are you looking for? Is it going to be all cash, or are you willing to take some cash and finance the difference? And then also, I would suggest that you inform your best suppliers about your plans to sell, but be careful. All right, so let's discuss each of these points in more detail. First, what is your succession timeline? If you've said 3 months, I would suggest that you stop now, take a deep breath, and continue watching this podcast series. Unless you've already developed a succession plan and you're well into the final stages of the plan, you are probably doomed for failure. You'll probably get into a bad deal that will hurt you, hurt your clients, and hurt your staff. As well, you may not fully realize the full value of your business. If a business owner was to approach me and tell me that they're buying a business that will close in 3 months, the alarm bells would be ringing in my head so loudly it would give me a pounding headache. A proper and well thought out exit strategy can take several years to see from start to finish. There are some deliverables that can be done in parallel with other deliverables, and then some that just cannot. Let's look at some of these key deliverables of an exit strategy. Again, develop a buyer profile. This could take several months. Take an inventory of what your current client offering is and what enhancements, if any, you would like to introduce to your clients. And let's take the example of a financial advisor. This is something that that's near and dear to my heart. This used to be the business that I was in. Let's say that you focused your business on fee-for-service financial planning and have not focused your energies into other various investment solutions. If your clients have been asking for these extra services, this would be a great time to consider a buyer that can provide these complementary services. As well, when you get into the client transition stage and you're introducing the new buyer to your clients, wouldn't it be great to say that the clients will benefit as a result of these new services that you've made available after closing? Needless to say, but it must be said, do not sell your business to a buyer that cannot or will not, at a minimum, provide the same levels of service that you've provided for years. In the same example of a financial advisor, if let's say you've provided income tax preparation for your clients and the new owner cannot or will not, you'll have anarchy on your hands. Your clients will be upset with you and may ultimately leave to join a competitor. If this happens, the client retention clauses in your purchase agreement may kick in and reduce your valuation. Next topic, how do you find the right buyer? Luckily, there are many ways to find the right buyer. You might be one of the lucky ones and already have someone in mind, such as an employee, a family member, partner, or a respected colleague. If not, consider speaking to various suppliers in confidence. Suppliers will have knowledge and they may know of someone that fits your profile. Please be careful, as the more people that know, the harder a secret is to keep, obviously. Another idea might be, are you familiar with a similar company that you've heard good things about? You may want to call this person and ask him or her to join you for coffee and a discussion. I'm sure that most competitors that are younger and growing their businesses would welcome such an invitation. Next question that you want to answer, will you select one buyer prospect or will you approach multiple buyer prospects? How do you ensure that you've reached the best price and the best deal for selling your business? Well, it could be simple, takes a little bit of extra work, but you can create a competitive bidding process. This is a process that is an effective way to ensure that you maximize all of the benefits of selling your company. A competitive business process simply means that you will approach, say, 2, 3, or 4 potential buyers and ask them to provide an offer to buy your company. You'll provide each of these prospects with identical information, inform each party that several parties are reviewing the business, and structure the process with timelines and guidelines for when you expect the offers to be received and other expectations that you may have, such as employee retention, etc. We'll have more information on this topic in future podcasts, so be sure to stay tuned. Now, big question. How will potential buyers view your business? You know, there's the old saying, you never get a second chance to make a good first impression. How true. If you were to visit the offices of a company that is for sale, how would you react to old and tired looking furniture, dirty carpets and walls, burnt out light bulbs, out of date marketing materials, information with typos, and so on? I know that I would look at these things as minor, but as an indication of a poorly managed company. So start with the physical and visual stuff. Whether it's a coat of paint or out-of-date marketing material, start here and get everything cleaned up before your first buyer prospect comes knocking. Review any materials that you may decide to give to a buyer and ensure that it's accurate, current, and free of typos. Now, the other thing too is that when that buyer comes into your office, regardless of which staff are aware of this transaction or not, you should inform the staff that a VIP is coming to the office for a meeting and you want to put your best foot forward. Clean up and tidy up the desks, reception area, meeting rooms. Ensure that the visitor is greeted with a welcoming smile, a coffee, and all of the VIP treatment that an important customer should receive. Let's talk about your corporate website if you have one. The first place that a buyer, and clients for that matter, will visit is your website. Has it been kept up to date, or does it need some attention? One of the telltale signs of neglect is a website that has old postings and evidence that the website has been largely ignored for many months or years. Another big issue and factor is to review and organize your financial statements. Are your financial statements up to date and accurate? If a prospective buyer asks for the last 3 years of income statements and balance sheets, would they be accurate? If not, speak to your accountant or hire a competent accountant to get your statements organized. Make sure that any personal expenses that you may be claiming through your company are identified for the buyer. For example, as a purchaser, I would be interested to learn which expenses will remain after the seller departs and which will leave with the previous owner, such as dinners, golf expenses, travel, and etc. Our next point is develop a business overview document for prospective buyers. Not that complicated, but it will take some work. This is a selling document for your business. This can be in the form of a Word document, spreadsheet, or PowerPoint presentation. The objective of this document is to give prospective buyers an overview of your business in detail and allow them the information that they need to decide if they will make an offer. Of course, one of the things that you'll want to do is, prior to giving out any of this information, is making sure that all of these prospective buyers sign a non-disclosure agreement, which should be developed by a competent lawyer. This document will also take some time to create, as it's full of information on your business. If you've never done this sort of exercise, it should be a real eye-opener for you as well. You might find something interesting in your business that could be corrected easily and have your business look more favorably to a prospective buyer. While you're doing that particular document, it's going to force you to review business practices and decide on what you're going to keep and what you're going to drop. Over the years, you may have begun new services and or business practices that haven't really gone anywhere. That's okay. That's what businesses do. Some work, some don't. If you can easily unwind these unprofitable practices prior to selling your business, it may improve your bottom line numbers and valuations. Here's a big one, and I'm going to give you a new term that you've never heard of, but fire your problem clients. I know that this is one of those easier said than done situations, but if it can be done without disruption, consider doing it. Why pass along all the PITA clients, P-I-T-A, which stands for pain in the, to the new owner? If you can get rid of those PITA clients, do it now. Another issue that you'll want to think about, and another thing that you'll want to focus your energies on, will be communicate your plans to your employees and stakeholders. This is obviously a sensitive issue, but extremely important. It will be hard for you to develop and then implement an exit strategy without some of your staff in the know. Ensure that your key employees are aware of your intentions to sell. They will be concerned about their employment status after the sale, and you'll want to give some serious thought on how you're going to answer those questions and their questions. Typically, most new owners, at least most smart new owners, will want to retain some or all of the key employees. New owners understand that keeping key employees, especially the employees that have had extensive client dealings, is important to ensure an efficient transition to the new owner. Next topic is, what kind of financial arrangements are you looking for? There's two ways that you can sell a business. If you have the business incorporated, you can sell your corporation. If you're not incorporated, you're going to be selling the assets of the business. And the assets could be, obviously, your client revenue is considered an asset. Now, even if you're a corporation, there could be some buyers that insist on buying assets versus a corporation. So let's look at these two different issues. The tax laws regarding proprietorships and incorporation are different in every country. So let me speak about what they are in Canada. In Canada, buyers and sellers receive varying tax benefits or disadvantages based on whether they are buying and or selling an asset versus a corporation. Incorporated sellers in Canada would prefer to sell the corporation so that they could realize a tax-free capital gain of up to $1.25 million as a lifetime capital gains exemption, whereas buyers would prefer to buy the client assets and move them into their own corporation. For qualified small business corporation sellers in Canada, the owners of the corporation could be eligible to receive the first $1.25 million of the selling price on a tax-free basis, something that you'll want to definitely double check with your competent accountant on this. This is very attractive and understandable why a seller would want to insist on this. The buyer now has some disadvantages with buying a corporation. First, the buyer has fewer tax write-offs versus an asset purchase. The buyer can depreciate the assets when assets are bought over time and receive favorable tax treatment with an asset purchase. Furthermore, when buying the corporation, the buyer takes on all the prior liability of the corporation, such as prior income taxes collected and remitted or not remitted, previous employee matters, supplier agreements, and other contractual obligations that will follow and move to the new owner. With the significant tax savings that you could be eligible to receive from selling your corporation, I would suggest that this would be the route that you want to take. Please keep in mind that a knowledgeable buyer will insist on a more detailed share purchase agreement to deal with these added liabilities. As an example, you can neutralize this argument by insisting on a My Watch, Your Watch principle. A My Watch, Your Watch principle simply states that the seller will continue to remain responsible for all matters of the corporation that happened under the seller's watch up to the closing date. And the buyer will be responsible for all matters that happened under the buyer's watch after the closing date. A competent lawyer can draft a share purchase agreement to reflect this key principle. Once again, strongly suggest that you speak to an accountant about your specific income tax situation. Let's talk about payment terms. Depending on the size of your business and to whom you're selling your business to, it may be difficult for a seller to provide you with 100% cash down payment. As a matter of fact, I strongly suggest to buyers to never give 100% down payment. It does not give the buyer any recourse if assets should leave or undisclosed expenses should arise. Depending on who is buying your business, you may decide on different terms. As an example, if you're selling to a family member, you may decide to not accept a down payment at all, or a small one with the family member paying you a monthly or quarterly payments over a number of years. Let's talk about terms versus price, selling price. In my opinion, more terms should equal a higher price. Let's compare two purchase offer examples. Number one, which one do you think is more favorable? Someone who is going to offer you a 60% down payment and the remaining 40% to be paid quarterly over 3 years, or someone who's going to offer you a 50% down payment and the remaining 50% to be paid quarterly over 5 years. While this is a very basic example and other important factors have to be considered, generally speaking, I believe the first offer is more attractive from a seller's point of view. And if you felt compelled to accept the second offer, you may consider either demanding a higher price or asking for interest to be provided on the remaining 50% to be paid quarterly. Let's move on to suppliers for a second. Important suppliers should be informed about your plans to sell. I believe that in most circumstances, you should inform your trusted suppliers of your intentions to sell your company. A supplier may be able to offer some good guidance on who might be a good candidate to buy your firm. The buyer may have an attractive financing options that the buyer can take advantage of, and the supplier may be able to offer some legal and accounting assistance. Yes, Some suppliers will be motivated to keep your business within their firm, and a smart supplier will see this as an opportunity to help you transition to retirement. And if they've done their job right, they'll retain the business within their own company. Folks, that's enough information for today. Please stay tuned for our next podcast on how to value your business and some business valuation examples. If you subscribe to this channel, you'll automatically receive a notification whenever we post a new podcast. Again, at the risk of sounding like a broken record, please ensure that you don't entirely rely on this information without speaking to your own lawyers, accountants, and professionals before taking any action. Once again, thank you for listening, and we'll see you soon.